Hello, my name is Craig Hughes. I'm a tax director at Brown Butler Accountants based in Leeds. I'm going to talk to you today about two significant announcements made in the recent budget on the 3rd of March regarding the new super deduction for capital allowances and the increase in corporation tax rates. Starting off with the super deduction. In summary, it applies to companies only. And two new first-year allowances have been introduced. Firstly, a 130% first-year allowance for general pool assets, applying for qualifying expenditure incurred from the 1st of April 2021 to the 31st of March 2023. So this would be for any assets that qualify as plant and machinery for general pool purposes. There's also a 50% first-year allowance for special rate pool assets acquired in the same period. This would typically include your integral features expenditure, so items such as electrical systems, cold water systems, and air conditioning, and the like. Expenditure qualifying for the super deduction is only on new assets. So used or second-hand assets do not qualify, and there are some other exclusions as well, which I'll come on to shortly. The annual investment allowance runs alongside this first-year allowance, and therefore you could claim either or relief. You may want to claim the annual investment allowance on special rate pool expenditure, for example, because you only get a 50% first-year allowance on that expenditure. And remember that the annual investment allowance of £1 million is reducing to £200,000 from the 1st of January 2022. Now, sting in the tail for the super deduction is that when you claim the first-year allowance on a disposal, the proceeds are treated as a balancing charge rather than a pool deduction. And I'll go through some examples shortly explaining how that works. I mentioned before there's some exclusions to the relief. Cars and long-life assets do not qualify for the super deduction, nor do leased assets. And that can cause a bit of an issue for landlords and also parent companies leasing assets intra-group. There are some representations being made in respect to this point, and so there may be some further developments before the legislation gets royal assent. So moving now into the detail, an adjustment is required where the accounting period straddles the 1st of April 2023. And this is when the main rate of corporation tax increases. So by way of example, if you had a year end of 31st of December 2023, the rate of the super deduction is calculated as shown here. You look at the number of days in the accounting period falling before the 1st of April 2023 and compare that to the total accounting period. So for a December 23 year end, we have 90 days falling in the period before the 1st of April 2023, divided by the number of days in the period, times 30% plus 100%. So the rate of the super deduction here would be 107.4%. But remember, the expenditure still needs to be incurred before the 31st of March 2023. On the disposal, we have a similar adjustment to be made. If the accounting period ends before the 1st of April 2023, you simply bring in 1.3 times the proceeds. Where the accounting period straddles the 1st of April 2023, again, you make a similar adjustment as we did for the acquisition above. So a disposal in the year ended 31st of December 2023, the way the multiplier is calculated is that you look at the number of days in the period before 1st of April divided by the total number of days in the period times 0.3 plus 1. So here the multiplier would be 1.074. Where the accounting period commences after the 1st of April 2023, there is no multiplier. You simply bring in the proceeds as being the balancing charge. And remember, this is for the 130% super deduction. I'll come on to shortly to explain how the special rate pool deduction works. Now, the reason for this adjustment is so that very broadly, the effective tax rate for tax relief on the acquisition is similar to the effective tax rate for taxing the balancing charge. Let's look at an example. Here we have a company with a year ended 30th of June 2023, and it acquires qualifying plans for £300,000. To calculate the super deduction, we look at the number of days in the period falling before the 1st of April 2023, compare that with the number of days in the accounting period, times that by 30% and add 100%. So here, the super deduction rate would be 122.6%. Applying that to the expenditure of £300,000, we would have a deduction of £367,808. Tax relief on that would be at 24.5%. So that's the main rate of corporation tax for that period, take into account the increase in the main rate from the 1st of April 2023. So the overall tax relief there would be £75,400. That would give us an effective tax rate of 25.13%. Taking that further, let's look at an example of a disposal in terms of how the balancing charge works. Here we have a company with a year end of 30th of June 2022 and it acquires qualifying plant for £500,000. The super deduction, straightforward, is simply 130% times £500,000. The accounting period doesn't straddle the 1st of April 2023. So we have a £650,000 deduction at a corporation tax rate of 19%, because the main rate hasn't come in yet. And so we'd have a tax saving of £123,500. If we sell the plant in the following period for £200,000, we have a balancing charge because we've claimed the super deduction. And the multiplier for the balancing charge here would be 1.226, because we're looking at the number of days falling in the period before 1st of April 2023, comparing that to the total days in the accounting period, multiplied by 1.3. So the balancing charge would be 245,200. The tax rate will be 20.5%. It's a 30th of June 23 year end, so that would be the main rate of corporation tax for that year. And so we'd have a tax liability of 50,266. The overall tax relief on that transaction of buying and selling that asset is an effective rate of 24.41%. Now, if the disposal took place in the year ended 30th of June 2024, the balancing charge would simply be £200,000 at 25%, so a £50,000 tax liability. And the effective tax rate in that scenario will be 24.5%. So moving on now to how the special rate expenditure is dealt with. As mentioned previously, acquisitions from the 1st of April 2021 to the 31st of March 2023 qualify for the 50% first year allowance if it's qualifying expenditure. On disposal, we have a balancing charge on the relevant proportion of the disposal value. In most cases, this means it's 50% of the disposal value. And for the special rate pool expenditure, there is no adjustment for accounting periods which straddle the 1st of April 2023. So here's an example of how the special rate allowance works. We have a company with a year end of 31st of March 2022, and it acquires special rate plant for £250,000. We claim the first year allowance at 50%, so we claim a super deduction of £125,000, tax relief on that at 19%, so we save £23,750. 4 years later, we sell the plant for £80,000. We now have a balancing charge because we claimed the super deduction on the acquisition, and the balancing charge is 50% of the proceeds, so £40,000. The main rate of tax is 25% by that point, and so we have a £10,000 tax liability. The remaining £40,000 of the proceeds are deducted from the special rate pool. And we carry on claiming the 6% writing down allowance on the initial £125,000, which we didn't claim the super deduction on, less the £40,000 proceeds, which weren't subject to the balancing charge. Now, one important aspect of the super deduction is the timing of the expenditure. particularly for contracts entered into on or around budget day on the 3rd of March. Any contracts entered into before budget day do not qualify for the super deduction. And within the finance bill, there's the following clause which tweaks the date of acquisition for capital allowances purposes in respect of the super deduction. So for the purpose of determining when expenditure is incurred for the super deduction, if an amount of expenditure is incurred as a result of a contract entered into before the 3rd of March, we ignore Section 5 of the Capital Allowances Act, and the expenditure is instead treated as incurred when the contract was entered into. Now, this is important because Section 5 of the Capital Allowances Act is the provision which deals with the time of expenditure for capital allowances purposes, and expenditure is deemed to have been incurred for capital allowances when there is an unconditional obligation to pay, which could be later than the contract date, usually on delivery. And so for the purposes of the super deduction, Section 5 is ignored, and we have our own rules. There are also broad anti-avoidance provisions to cover any arrangements to get the super deduction where otherwise you wouldn't. And here arrangements include any agreement, understanding, scheme, transaction, or series of transactions, whether or not legally enforceable. Therefore, we have a very broad definition of arrangements. Now, just a reminder on the annual investment allowance, as I mentioned earlier, this continues to apply and runs alongside the super deduction. It's reducing to 200,000 from the 1st of January 2022. And there are some transitional rules around accounting periods which straddle that date. So in the year to March 2022, in the example here, we straddle two limits. And the AIA for the whole year is £800,000. You have 9 months at £1 million and 3 months at 200,000. However, for expenditure incurred in the period between the 1st of January 2022 and the 31st of March 2022, we can only claim the AIA on £50,000 of expenditure. Therefore, in order to maximise the benefit of the AIA, it's important in this example here that expenditure is incurred before the 31st of December 2021. Just something to remember. Okay, moving on from the super deduction and capital allowances, one of the main announcements of the budget was the increase in the main rate of corporation tax. So it's going up to 25% from the 1st of April 2023. The small companies rate will remain at 19% and will apply to profits up to £50,000. The main rate will apply to profits over £250,000, so we have a marginal relief calculation to do. And profits falling between those two limits will be taxed at an effective rate of 26.5%. As we now have two rates of corporation tax, the rules regarding associated companies are being reintroduced, and also we need to consider whether the company is a close investment holding company, because they do not qualify for the small companies rate. With the main rate moving to 25%, the calculations around profit extraction, when we're looking at salary versus dividend and the benefits of incorporation, those will now change and will need to be revisited. The effective tax rate of taking a dividend compared to a salary will be far closer if the main rate of corporation tax applies. And likewise, the benefits of incorporation utilising lower corporation tax rates compared to income tax rates, that will reduce. As always, this all needs to be looked at on a case-by-case basis, depending upon the particular fact pattern. But certainly, in most cases, it would be more marginal now with regards to the benefit of incorporation and looking at the salary and dividend mix. I mentioned the associated companies rules were being reintroduced. And just as a reminder here, we ignore dormant companies and passive holding companies. There are some strict conditions to be met in order to qualify as a passive holding company. And one company is associated with another if one controls the other or both are under the control of the same person or persons. And here, for control, we're looking at the Corporation Taxes Act 2010 definition, voting, share capital, rights and the winding up. But remember, we also need to attribute the rights of others. And typically these will be relatives. Finally, just a reminder regarding the rules around close investment holding companies. As I mentioned, they will not be able to benefit from the small companies rate of corporation tax. Now, a company is a close investment holding company unless it carries on a trade, it lets land and property commercially, unless to a connected person, and you also look at associates there, or it's the holding company of any of the above companies. Thank you for listening. I hope you found the presentation helpful. If you have any questions, please do not hesitate to contact us, and goodbye for now.